Let's actually put this to James Sullivan, Managing Director, Asia Pacific Equity Research at JP Morgan. James, good to have you with us here on CNBC TV 18. Appreciate your time. I just wanted your thoughts on this debt ceiling business, because twists and turns we've seen, but there's not very much time left now for more twists and turns. If it is indeed 1st of June, your own sense on how this is likely to pan out and what are implications for markets around the world?
Sure. Thanks very much for having me on the program. The first thing I would say is, from a timeline perspective, JP Morgan is estimating that the X date, the day on which the U.S. federal government will run out of enough money to pay its short-term bills, will be June 7th. The critical element to that is, on June 1st, you have an $80 billion payment for Social Security and Medicare. So you'll be very, very tight after June 1st, but we are still looking for a couple of incremental days to try to work to a solution, which is important in terms of the overall shape of markets. I think the nerve-wracking thing here is what you've already highlighted earlier in the program, which is that markets are generally ignoring this. If you look at volatility, volatility is still sitting at the lows. The vol statistic is actually only pricing in roughly a 3% odds of recession. So there's very little fear built into markets at this stage, which is one of the reasons why we're arguing investors should look to this opportunity to raise cash and come in on the back of any volatility and turmoil that we might see in markets.
Okay. James, hi. How are you feeling about the Indian market now? Because, you know, it has a special place in global markets as we speak, considering that valuations are looking much more reasonable compared to what we saw last year. Growth is picking up. GDP expected to be, 6.5% plus. At such a time when both the valuation and the growth argument are working in favor of India, has the time come to raise your allocation as a global equity, observer towards a market like India?
It's a great question, and there's really three things that I would focus on as an answer. Number one, it is important to recognize that you've seen significant fund flow largely out of China and into India on a year-to-date basis. The average institutional investor right now is already overweight India, so there is a marginal incremental buyer conversation to be had, would be point number one. Point number two, as you rightly say, expectations are not that low right now, particularly as it relates to earnings growth. Street estimates for this year and next are looking to 18 and 15% EPS growth for the overall Indian market. JP Morgan estimates put that somewhere closer to 11 to 13%. So we are looking at the potential for downside as we go into the next 6 to 12 months. The third thing that I would note from a macroeconomic perspective is that foreign direct investment into India has dramatically slowed year to date. And this is something I don't believe we're talking about enough. It's more than halved as a percent of GDP, which is somewhat startling given the opportunities with China Plus One and supply chain relocation, as we've discussed in prior programs. So if you put that together, I still think there are very clear things that we need to be paying attention to in the Indian market. The one sector where we do see an asymmetry of risk, as you've already stated earlier in the program, is really the banking sector. Earnings have already been cut extremely aggressively, and we think we've formed a baseline for outperformance going forward.
All right. Hi, James. Good morning. Over the weekend, I was reading a couple of articles, and after a while, I'm hearing about not a pause, but there's an outside chance of another rate hike from the U.S. Fed. Do you think there's an outside chance, going by the inflation data and the unemployment data as well? They seem to still give that outside chance a bigger chance. Your take.
So massive volatility in the conversation. JP Morgan's view for some time now has been that we will be on a pause for an extended period of time. If you look back 2 weeks ago, markets were pricing in 100 basis point of rate cuts by the first quarter of next year. On Friday, you're absolutely correct. You saw a movement from a 0% odds of a rate hike to a 35% odds of a rate hike. That's now normalized back to about 20%. But again, volatility is the watchword there. The macroeconomic statistics are somewhat confusing. Our base case, however, is that the global all-industry PMI is still looking for global growth of about 3.3%. You are seeing some signs of disinflation, particularly in emerging markets, but we do think the U.S. economy is, in general, holding up significantly better than where people had been thinking earlier this year.
James, you said that your advice, JP Morgan's advice to investors is to raise cash. The impact of this debt ceiling thing is largely limited to the U.S., or you think this could percolate to other markets as well? And you are, if you're asking investors to raise cash, that means that you are expecting some volatility and some big moves, which should give the opportunity for people to get in when that happens. Go on.
Again, great question. The only volatility that we've seen so far has largely been to the upside. As you posted on an earlier graphic, U.S. markets were up last week, which is slightly contradictory going into the debt limit ceiling as early as the end of next week. And so we don't think that there is really any level of fear baked into particularly U.S. and European markets. We are underweight both the U.S. and Europe from an equity perspective, overweight emerging markets. And so to your point, I don't think you'll see significant contagion into EM. But we do have to reflect on the fact that U.S. Treasuries are still a key cost of funding for many large multinationals around the world. So if you see funding costs go up, the potential for investment reductions to occur could create an incremental drag on global growth.
James, if there is an issue, yields will fall, right? Or will they rise? They should fall, I'm assuming.
So it's a great question, because one of the odd things about the centrality of the U.S. market to the global economy, in a flight to safety, you sometimes see effectively safety buying of U.S. Treasuries, despite the fact that the U.S. Treasury is exactly where the risk sits. And so you get this odd dynamic in global markets. From an equity market perspective, however, we do think that you're likely to see the risk-free rate of return go up, the perception of risk go up, and therefore markets likely trend down. The critical thing that we would focus on, particularly in the U.S. market, is the very narrow breadth of market outperformance on a year-to-date basis. You've effectively had 6 to 8 stocks leading almost the entirety of U.S. equity market performance. And so that narrowness of performance is interesting. We do see the potential for a rotational trade out of those top 6 to 8, which are largely the mega cap tech stocks, and into the broader economy on the strength of that economy over the medium term.
Okay, James, we will let you go on that note. Thanks a lot for joining in and speaking to CNBC TV 18. That's JP Morgan with their view on the global markets and also how to approach a market like India. Let's slip into a quick break. It is the fag end of the earnings season, the last leg, so to speak. Lots of stocks in focus when we come back on the other side. Also, the SGX Nifty indicating a slightly weakish start, so do stay tuned in for more on Bazaar Morning Call.